Live streaming is on.
All right. Good afternoon, everybody. This is Gavin McGuire, event trader. Getting ready for another episode of the Sentiment and Flow Show. And of course, that means that we will be inviting in chart trader Brett Manning to discuss what's going on in the markets here and what's really been kind of a choppy few weeks. So, Brett, how are you doing today, my friend?
I'm doing very good, Gav. How are you?
Doing pretty good. Doing pretty good. How are the triplets doing? They back in school at this point now, or
They're
what?
back in school. They're big first graders now. They're super proud of that, and
Uh,
they're losing lots of teeth.
I heard that a few of the Chicago schools had off today because of the excessive heat. I assume that
Isn't
they're
that
not
just
one of them.
ridiculous?
Yeah, I remember going to school without any AC and never really
I
having
went to
that as
school in Florida.
yeah,
Are
yeah,
you
right.
serious?
Like through Hurricane Andrew and stuff, right?
We had like heat index of like 140 degrees as an average daily thing.
Yeah, yeah. Well, I guess
Am I old? I think I'm old now.
I'm definitely old. I'm a
Kids these
curmudgeon. Off
days.
my lawn. Off my lawn. Well, speaking of yelling at people to get off the lawn, it definitely seems like that's exactly what the Bears were yelling at the Bulls today when we had that nasty reversal. So I would certainly be remiss not to ask you
Yeah.
about your current market thoughts. So I know for me, I was trying to play around with some shorts yesterday. I was obviously a little too early. I basically this QQQ I wanted to have on a hedge in case we saw price action
Mm-hmm.
like this. What I wasn't expecting was that little face ripper rally that
Mm-hmm.
happened that ended up pushing me out there. And then, of course, we did get the NVIDIA results. And, Brett, you know how long I've been doing this for. I think it's something like 88 earnings seasons or whatever
It's like
with briefing
55
alone.
years, isn't it? It's like
It's
60 years.
at least, but it feels like 100. But like that was one of the best earnings reports I've ever seen,
And that
and
means something.
yeah. I mean, like, and, we've definitely like the Zoom ones back at the beginning of COVID and stuff.
Right. Right.
They were on par with this, but I mean, there's nothing like this. I mean, definitely could be viewed as a seminal moment in terms of the monetization of AI. But I guess one of the problems, of course, is that NVIDIA seems to be the only one that's really done that, and I think that's kind of factored in. So I'd be really interested to hear your thoughts on the NVIDIA, what it means for the broader market, in your opinion, and AI in total, but also this reversal, how you're kind of seeing an event that's as positive as that NVIDIA news, yet we see this shakeout. And we talk about it in the context of this. The last time NVIDIA came out with sort of this Mickey Mouse type numbers was back on May 24th, and we're going to be talking a lot about that in the sentiment data because you're going to see a little bit of rhythm going on there in terms of where sentiment data was at the time of that. Yet here we are in a completely different price action, it would seem, where that May guidance that they gave kind of kicked off the AI infusion and really set off the animal spirits for a nice summer rally. However, this time around, we're getting a little bit of a return. So I'm real curious to hear what you have to think about that.
Yeah. So, I mean, my perspective on this market over the last 6 months and then over the last couple of weeks has been basically, where are the ideas that people are leaning the wrong way on that are going to turn out, in a better than expected way, and you know, if you trace those out, like we had a whole big bundle of them set up into pretty much toward the end of July. You had a situation where there was the let's say the standard zeitgeist was about inflation not being able to be brought back down. So there's the better than expected idea of suddenly we're at 3% inflation by the early summer. Or the Fed hiking cycle is just going to go on and on past 6 to 7%, and suddenly here we are at 5.25, and the Fed's saying basically it's done. Or earnings are going to be a complete disaster in Q2, and suddenly here we see that's not at all the case. There's a long list of things that if you go back to March that were vulnerable to coming up in a way that didn't work out for bears, and we've kind of with Nvidia's report, it really puts the capper on being past all of those that are foreseeable to me. Like I don't think the market knows what to look for next as the thing that people are leaning the wrong way on, as a dynamic, as an idea, as a concept that's going to come up much better than expected, right? And so we rallied in through all of that, and by the time we got to kind of, you know, around the Fed, and the next day was Apple, and that was kind of a crux point, pretty much forms the highs of that trend, is right that period where the Fed's saying we're not going to hike anymore, Apple saying we did better than you thought. And that's just the, you know, the third mega cap in a row to say the same thing. And that kind of forms this, you know, this sort of like, you've got the rumor and then the news all blowing out the bears. And we're going to probably talk about some of the levers that we saw in the hedge fund community on the short side getting blown out and them capitulating out through, you know, late June and through July, as they started to experience this transition from one outlook on the market to a very different kind of outlook, which is more normal. You know, it's not this terrible catastrophic situation that everybody apparently thought we were in. If you went back to February and March, we've transitioned to a different kind of world in, you know, June and July. But by the time you get through NVIDIA, you know, where's the next data point that's going to underline that transition in a way where everybody's still leaning the wrong way? You know, it's not there. So now we're going to need the next narrative, which is going to be something much more constructive. It's got to be much more full-bodied in the same direction. And I don't know what that is, but it's clear to me today that the market doesn't know what that is either.
Yeah, no, that's definitely pretty evident. You know, it really feels like it's not going to be a specific data point that's new as much as an avoidance of some downfall in data points, which we'll get into later on in the show. So with that, we are going to kick off the show. Let me get my presentation up here. All right, there we go. We should have it up. All right, so let's get it started, Brett. AAII data here. We got some fresh numbers on the board, and just kind of taking a look at this right now. You could see August 23rd came in at 32.3%, down about 360 basis points from August 16th. This was the lowest number since May 31st. Again, you're going to see some parallels going on between this NVIDIA report with the sentiment and the NVIDIA report guidance that we got back on May 24th. Now, we also saw sentiment fall from the neutral area from 34% down to 31.8. So clearly everybody went from the bull or neutral side to the bear side here. Bearish sentiment came in at 35.9%, its highest level since May 31st, which of course, again, is when NVIDIA was out. Here it is, taking a quick look over the last 4 weeks. You can kind of see that stair stepping down of the bullish sentiment and the step up of the bearish sentiment there. You know, bullish sentiment running below the historical average of about 37.5 now the last 2 weeks. Bearish sentiment slightly higher here, neutral pretty much in line. The 1-year high for bears, of course, was back on July 19th, which was right when we were getting started on earnings season there. Also happens to be around the last time we ran the sentiment flow show, Brett, on that date there. And then the 1-year bearish high, that would have been all the way back in September at that 60.9%. And then, of course, here is kind of a running total of the bullish 8-week moving average, which we have at right around 44.39. That obviously will be coming down here when we start factoring into these numbers. And that bull bear spread, which, as you can see here, turned negative again. First negative since June 1st, right? So again, going back to that May 31st area when NVIDIA was last reporting. So we've kind of gone on a whole roller coaster ride here, Brett, of the bullish sentiment reaching its peak around the 19th and then once again declining here. So how's your read on that in terms of, you know, looking at what the market's done and looking at that sentiment data?
Well, it's been a really good indicator lately in terms of kind of capturing things, especially if you consider that when you're looking at this slide with the 8-week moving average and the bull bear spread, if you go back to last October, pretty much, you've got this really negative situation for the bull bear spread for a long time straight before we blossom into this recent period of of how bullish everybody's been for
I believe you deemed it the bubble in risk aversion.
so we had a bubble
meeting.
in risk aversion. We had a mania in risk aversion, and that's confirmed by like 100 different data points. And I've been doing this for 25 years, watching sentiment data. I can tell you, this was a bubble in risk aversion that we had, an inordinate one, a one that wasn't really backed up by a lot of the facts. People just got that way for some reason this period, and that's important. And we've been talking about this for a while, but when you see what happened in June, the transition out of that, the sudden burst into this 20% positive bull bear spread from this persistently deep negative bull bear spread for 8 months prior to that, it's really like you see the stem of this plant coming up to the soil, and finally this flower just blooms on top of it. And that's what you got at the end of the rally, not the beginning of the rally. The rally was built, a lot of it was built like powering through that negative sentiment. It's the rally that turned that stem into a flower in June, that really kind of forced people to reappraise things, because even though you've got theories, it's what's the Mike Tyson line? Everybody's got a plan until they get punched in the face. And that's what it was like to be a short through all spring. You think and the market's going against you, and eventually you're just sitting there like in tatters, and you've got investors pulling out and your capital's just beaten up. And so we saw this mass conversion, and we have data points that show just this huge liquidation of short interest in June and July. And for no other reason than just like it's not happening. You've got this thesis, you've got this theory, and it's not happening. And so you just eventually, with the rally, you just have to kind of protect yourself. And that was the nature of the rally that we saw. Now, the nature of this decline is a perfect job of sort of starting to reset this. And if you go back to just, tracing out each week's score in this, to see it, to see the bullish percentage, in the 40s and 50s for a while, and then market starts to get hit, and then down you go to 36, then down you go to 32. That's what's supposed to happen here. It's a resetting. It's a rebalancing. It's kind of, you can't have too much. We had 9 straight weeks, I think, of like just overly bullish, kind of scoring in this survey. And so, yeah, you're going to need to kind of check back against that.
Yeah, and just with regards to that too, we're keeping an eye out on the markets here. S&P getting close to a test of that 4,400 again. Yesterday's lows was 43.9950. Nasdaq also down near the lows. Quick question on the markets here, Brett. Are you concerned about the lack of a bounce here off of some of yesterday's lows?
No, I'd like to see a check below yesterday's lows, and then I'd like to see a bounce up until a decisive lower high midway through today's range or so, and start fading, looking for a retest of the ultimate lows so far of this correction. I mean, that's what I would ideally, that's my ideal pattern.
The ultimate lows in this current cycle?
In this corrective wave we've seen over the last few weeks.
In the corrective wave. So for that would be back on August 18th when we hit that 43.50 area, basically.
Yeah, I mean, I'd like to see it pop back up to 44.40, 44.45, and then a move back down to 43.40 and flush that out. I think if you get that secondary flush out, in my experience, and that doesn't mean that's going to be what follows through here, but I talked about this in the swing trader column. Just my model for this kind of what I call a garden variety correction of significance in a bull market. It's kind of a big hodgepodge of words there, but it's a concept that's discrete to me. There is a bit of a panicky first leg. People go, whoa, something's wrong, after spending 3 weeks going, nothing's wrong. This is a great pullback to buy. And then it accelerates and you get people really hit. and you get people kind of starting to you get a reset of
Well,
sentiment.
the general thought, yeah, of there is those buy the dippers take a little bit longer to shake out, right? So that's why you get
Well,
that
that's
choppy
you get the
action, and then
first right.
once they kind of throw in the towel, that's when you get that more
Exactly.
aggressive acceleration of
Yeah,
things.
you get
So
the grinding move back to the 50 days or so, and people kind of are really, cheerily on board for that and looking at the wonderful discounts they're getting. And then, the any kind of bounce reaction to that isn't able to get much traction. And then eventually, having 3 or 4 failed bounces from that, and then you break to new lows, you break well under the 50-day, and you start to get a bunch of people who over levered because they were overconfident, and then they have to throw in the towel and they give up, and there's no bid there to brace it, and you get this little bit of an air pocket, a more directional sprint, and you get back down to maybe the lows of the previous range that you saw in the trend, which is exactly what we did here. And it's kind of, I've seen this, I feel like 100 times at least, this kind of structure. When you get there, you sort of puked out that extra fast money. And then you get a bounce, it gets aggressive, it gets to a particular point, and then it comes back to retest. And when you puke out that retest level, when you puke out that support, and you find what I call the no man's land bid. Like, the important thing in a bull market is that there's a bid at no level that everybody can obviously see. That's just in the empty spaces, in the empty wastes of space, between the solar systems. There's a bid there. There's a bid. It's just there because people need to accumulate. There's institutional money that hasn't found a home yet. And that's the nature of a bull market, is that bid is going to be there in these sort of empty places. And if you hit this obvious technical point, you bounce and you come back through and you puke it out, and you've got that money because everybody's got stops in the same spot at that point, 43.50 area, and you knock all those out, just dominoes out, and there's a bid there to brace it and to hold that. That's telling you something, and that's the thing that you need to see to understand where you're at in the cycle, is that there's deep pocket bids at a place like that, and that the market moves back above the 43.50 level after puking it out, and everybody takes notice then, like, that there's this deep pocket bid in a place like that, that's kind of insurance.
right, and obviously Powell tomorrow. So that's got to be getting factored in with some of this move here, the rejection at the 50s. So a lot on the plate, but that 43.50 level, I would agree, is definitely setting up as a potential key tester perhaps tomorrow morning when we get Powell. And we will get into Powell's or look at Powell here in a little bit. All right, moving on from the AAII data here, we're going to take a look at some of the broad market characteristics, and we're going to be circling back around and covering each one of these as we go through. But some of the things that we were seeing that were really catching our eye: hedge funds net leverage increased from 61% at the start of the year to 72% in July. That had been the highest since June of 2022. Still below the 5-year average, but certainly it works into that scenario that we were talking throughout the course of 2023, Brett, on this show. Just the under invested people that were slowly trying to sneak in. And that was certainly evident going on in some of the hedge fund data that we had seen from July. CFTC data that showed ex dealers US equity futures net length was the highest relative to gross exposure since 2022. So again, just kind of points towards that topping pattern going on there. Of course, we are well aware of all the money that was poured into the money market funds. 700 billion had poured into it in the first 5 months of the year alone. The potential bottoming of short interest, again clearing out some of those shorts over the last couple of months, but definitely seems like perhaps some people are reloading on that front. We've had the Fitch and S&P downgrades, of course, the Fitch downgrade of U.S. sovereign debt, and then the Fitch and S&P downgrades on the banking system there. That's really factored in. Macy's commentary earlier in the week, which really kind of was some of the first really cautious comments we saw about consumer credit starting to be on fallen on people's radars. Now they're coming off historic lows, but obviously with those rise in rates, that's something that people are going to be paying close attention to. Yields hitting their highest level since the great financial crisis over the last couple of sessions there. That's obviously been a major headwind for equities there. Is TINA, there is an alternative now at this point. U.S. volumes, Brett, they have been down about 50% month over month in August, your typical seasonality, but that illiquidity could be exasperating the situation a little bit. Questions about whether or not China is going to export some of its deflation and thus obviously help offset some of the central bank activity. The BOJ's yield curve control and how that could be impacting the carry trade. Seasonal weakness, which we're coming into that September month, which tends to be a poor month for equities in general. And then the corporate stock buyback window reopening. So how's that going to factor in to some of these areas? So we'll be going back around to each one of these individually, Brett. But out of that list, is there anything that's jumping out to you?
So I would say several. One, the hedge fund net leverage, and one of the interesting things, the first data point that you said, the increase from the beginning of the year to some point in July, as far as I understand, the significant amount of that leverage was short side, and then it capitulated back out. And by the end of July, net leverage was down quite a bit for hedge funds. That was the note that I read where we had gradually they were building bets against the market and then gave up. And I've got the HFRX comparisons that kind of back that up a bit. And the CFTC data, so in May, they were at their all-time highs in short interest in equity futures. So I don't know how to interpret highest net length right now. Could there have been that big a turnaround unless this is that much participation for small traders?
Well, my assumption on that, Brett, is obviously they're forced into buying if they're looking to cover their shorts, right?
So
that
maybe
probably,
both the same, right? It may be both the same, that there's just been so much covering.
But that's been a big argument, right, of this most recent run up in July, that it was shorts kind of throwing in the towel, right?
It absolutely was, for sure.
And very reminiscent of what we saw in January, of course, too, right? And that's one of the things that I find interesting, because obviously everybody tried jumping on the markets in the beginning of February once we got that low, because coming in, everybody's talking higher rates, tech's going to continue to get squashed, you got to get into banks and energy and stuff, and nothing could have been further from the truth with how the market fell over. So I'm kind of curious, Brett, do you think that this is potentially kind of a repeat of what we saw in January, where the short covering was in and everyone was like, oh, it's just shorts covering, we could come back in here and short this market? Then really just kind of got that face rip rally going in through the end of February into March. Of course, you had that big hiccup around the Silicon Valley Bank, but since then really had that nice upward trend channel going in from mid-March around St. Patty's Day all the way up until the end of July, and that's when we got this little correction here.
I think it rhymes, but it's different because we're at a different phase of trend. So we were, if you go back to earlier in the year, we were at a place where it was certainly, without doubt, still a big bear market, headed to much lower places. That was the average. That was the zeitgeist around the market, and there's been a level of transition that's happened since then, and I think that impacts everything. I think the base case has gone from, unquestionably we're headed into a deep recession later this year, to the average base case analysis is that we're going to hit the soft landing. We're at a point where earnings have proven to be more resilient. Like, there's the institutional money view on the market has transitioned to a different place to enough of an extent that all of these dynamics are going to be different. But there's a rhyme to it a bit.
Yeah, definitely a rhyme to it. So That's going to be one of the key stories for us to be tracking over the next couple of weeks. That's
And
for
one
sure.
of the thing, yeah. So I think the China deflation story is really, really interesting to me.
Where do you land on that debate?
I land that, yeah, it's a countervailing factor for inflation in the West.
You would think, right? Because
I can't imagine how it's not.
I mean,
How could it not be?
That's the world's largest exporter, right? So
How,
I mean,
but how could it not be? Oh, they
yeah.
always export their deflation. If
It
there's
is
a
certainly in
deflationary rate
Europe,
in China,
right? Their
it will
largest
happen.
trading partner. Certainly in Europe, their largest trading partner, right?
Well, yeah, but they've got a catastrophically imploding property bubble, as far as I can tell right now, to the point where, we're going to get no real data points from Beijing, and that only highlights it further about what's happening, is that it's out of control, and that how I can't imagine that does not end up being on some level net helpful for a lot of the West in terms of their inflationary issues.
Well, I mean, just on the demand issue on minerals and
It's a
metal
rate
and
hike.
everything, right? I mean, so that all factors in. Are you surprised that
It's a rate hike?
Are you surprised that we haven't seen the government move a little bit more aggressively on the stimulus front in China?
I think they did. They tried. That didn't work.
Yeah.
I guess. I mean, that's looking to me like the situation. And now they're trying all sorts of other things, like telling, their institutional money managers within domestic China to never be seen to be net sellers of equities. It kind of reminds me of the short ban here in July 2008.
Which we all know how short bands work out. That rarely is the solution, right?
It's like a price control mechanism. It doesn't work.
How about the Fitch downgrade? What's your thoughts on that?
For us?
Yeah. Non-event, or
I think it's a non-event, although I understand the very large picture. It's like there's problems.
Yeah, it's funny when people are so dismissive of it in terms of like market effect. Yeah, I agree with you, but in general, they're not wrong.
Well, I mean, because they first started talking about it months ago as we're politically dysfunctional, and you know what? We're politically dysfunctional.
Yeah,
and that has consequences.
That was on display last night for sure, right?
Well, there's no way around it. Like, this is a completely dysfunctional political system at this point, and that means there's lots of stuff you can't do, and there could be things that come up where you need to do those things, and we won't be able to do them.
Yeah,
and that is definitely a meaningful, factor in
government
shutdown, the credit quality of a situation.
You factor in the government shutdown into your trading at all? The potential government shutdown at the end of September?
I guess not really. Not now, until I see the whites of its eyes. I don't know.
But that would be something that would kind of,
I guess,
be a feather in the cap of Fitch if they're like, I told you.
It's still all kabuki theater at this point, really.
It is, yeah.
So, I mean, it's not to the point where it's like you really can't eat.
Right.
Like maybe you go on a hunger strike, but it's not true starvation.
Yeah.
Metaphorically.
All right. I'm just keeping an eye on the markets. We're getting a little bit of a bounce off this 4,000 or 4,400 level in the S&P.
So let's see 4440 and then we short it.
I don't think we're going to get up to 4440. That would be impressive.
Maybe not now, but maybe tomorrow morning. Hey.
All right, so we'll be circling back around some of these other market characteristics, but let's take a look at some of the BofA fund managers survey items of interest. Least bearish since February 2022.
Of course,
the cash dropped from 5.3% to exactly. Cash drops from 5.3% to 4.8%. Soft landing remains the baseline for these folks. Smallest equity underweight since April of 2022. So again, that positioning size coming off, and that wouldn't really reflect that it's all just short covering, right? There would be some potential real buyers there. Largest tech overweight since December of 2021. That's when, of course, everybody was piling into tech, thinking it was the only game in town because of COVID. Bear positioning, no longer a tailwind. We just went through that scenario there. EPS optimism, the highest since 2022, and we'll talk about how that factors into valuation
And
in
it
a
was a
little bit.
transition, right?
Pardon?
Was a dramatic transition.
Yeah, a dramatic transition
Look
from
at
the
3 month remarkable
headwinds.
transition. Yeah.
Yep. Then expectations for lower rates, the highest since November 2008. Of course, that also factors in with the idea that they've hiked rates so much, right, Brett? So,
Yeah.
there is different areas about that. But before we break into this, anything jumping off the page to you on that front?
No, I mean we like let's look at all this in context. A lot of times we're going to be saying sort of the same thing. So, relative to 3 or 4 or 5 months ago, there's been a big rally. And the big rally is related to a bunch of dynamics shifting in terms of how people think about them. And to our credit, we can go ahead and brag a little bit that Gavin and I were looking for that rally for those reasons. And it played out. So what do you do when it plays out? Well, eventually you get to the point where
It's
all of the
played out.
little yeah, right, but all the little drops of fuel that were behind that, all the stuff that we were saying 6 months ago, we're like, well, people are just off sides on this. Then eventually everybody gets on sides on that. And that's where you exhaust your fuel, and suddenly everybody's on the same side that you started on. And so you get to profit from that change in price, but then you've checked all the boxes at that point. And people checked all the boxes into the end of July, and there was very clear points that suggested those boxes were checked, and suddenly everybody was bullish, and there were no more future catalysts coming, and now we're in a correction, and you have to rebalance now in the other direction. And all of these data points right here on this screen are basically points of one side of that or the other of the need to in the first case to exploit the wrong-footedness, and then once it's exploited, the need to rebalance.
Right. So let's go through and take a look at all these items that we've just discussed, taking a peek at some of the charts. Here is the cash rule, contrarian buy signal. You can see you got the red lines there, and usually when it gets above or drops below, that's obviously the signal for where you're getting a little bit of a contrarian move. And certainly, again, as Brett was just talking about, that drop to cash down below 4.8, you can see falling below that red line there, which certainly playing out in the markets. Obviously, well down below that where we're seeing cash in October 2022, and not quite at those levels at the beginning of 2021 when everybody was piling into the markets, but factors into that, right, Brett? Here's cash versus equities, right? And this is basically just investors shifting out of cash and back into equities. So this is, the cause and effect, if you will, of that move out from the cash movements there. And you can see the least overweight cash since September 2021. And again, we just talked about the least underweight equities in a couple of months there. So that money moving off the sidelines and into equities. And you got to figure money market funds also saw a bunch of that cash, right, Brett?
Yeah, I mean, absolutely.
So that's factored out. All right, here's a chart. This is new to the Sentiment and Flow show. I know, Brett, you weren't thrilled with the naming of this chart, but I'm just going off with Goldman. So we can kind of talk a little bit about.
I'm a
And you can,
pedant.
what's that?
I'm a proud pedant.
There you go. There you go. So we'll figure out a new name for them and let them know about it. But I liked it because it kind of gives a nice little breakdown between institutional investors, retail, and some foreign investors and stuff. And as you can see, the dark blue is where we currently sit, and then the triangle light blue, that's where we were at year end. So kind of going through this on a step-by-step basis, Brett, you can see hedge fund exposure, which we've been talking about, that's moved up here. And you can see down at the bottom in the chart, they got the percentile rank versus the last 10 years. So it's moved up, but still not particularly high in that, right? So what would your read be on that particular metric there, Brett?
Well, I mean, it's pretty good, right? 77% or whatever overall.
Well, I got it. It looks like more in the 45% range. No,
What?
the hedge fund net exposure, the one up
Oh,
top.
I thought you were
You're
talking about
looking
the
at
very
that
bottom
sentiment
summary
indicator. Yeah,
sentiment. I thought you said all
no,
the way at the
the
bottom.
hedge fund net exposure, because we were just talking about
No,
that.
hedge fund net exposure. Yeah, sure. It's just chipped higher just a tiny bit. They're gonna be stalwart, right? I mean, they're committed.
Yeah. Now here's the CFTC net futures position. That's a big jump. A lot of that had to have been short covered. I know you follow that CFTC
Yeah, it has to be
data,
very
Brett.
recent too.
Yeah. So, what's your thoughts on that type of jump? Do you see that? I mean, now it's talking that's running up what in that 85 percentile? You got to figure, right? So,
Yeah.
what's your thought on a move like that? What's driving that? And is it sustainable?
Well, I mean, I think the other thing wasn't sustainable. I think that the level of hedging that was happening wasn't sustainable. I think that they're going to be. I would imagine this is still probably net short. I mean, I want to look it up, but like it's not all time record short equity futures.
Where,
So
but it was earlier in the year, though, wasn't it?
it
At one
was
point,
all
yeah,
time. Yeah,
yeah.
absolutely. And that's I mean that there's some times when it's been crazy short. But again, it's one of the things that was a corollary point to when I've said over the last 6 months or so, there's been a number of instances where I've said to me, one of the metaphors for this period that seems increasingly kind of interesting is 1994 and 1995 for what we're seeing right now. And that was a period when we had in 1994 we had all-time index futures net short. That was the record. And I think that's the record that we just beat in terms of total percentage allocation. So that it's interesting how those sorts of periods, it's kind of like speculative in a way. We haven't seen it's not a bottoming signal after a huge bear market. It's kind of like, there's a period where there's a lot of bearish sentiment that builds up, but the market hasn't really suffered too much of a hit, where we tend to see this. And that's, I think, the last time that was the case, and now we have it again, or we're moving out of it now. So, I'm not sure where it's headed. Obviously, I don't have a crystal ball, but that was another one of the points that has convinced me that that's maybe one of the more interesting potential corollaries to this period, with the technology revolution at the same time.
All right, then taking a look at the change in U.S. mutual fund positions, not a surprise there. That's popped up. Obviously, rates factoring in. This foreign investor one, that's pretty interesting. And we'll take a look at some global returns later. But that's a big spike. That's got to be just from how dour everybody was on the U.S. going in. And then throughout the course of this year, because, China was supposed to be coming back online. I was seeing a lot of money, with the end of the zero tolerance for COVID and everything. Europe was expected to recover against easier comps as the Russia-Ukraine episode was, I'm sure some were hoping coming to an end, but just a lot of people piling in. That's just got to be the least dirtiest shirt in the laundry, right?
I guess, except I just feel really skeptical about my ability to know exactly what's being measured there, just based on those 4 words sitting there.
Yeah.
I mean, it's a really dramatic change in a way that, I just don't know what they really, like, if you really were to get in the weeds of exactly how that data point is constructed, if it would seem like you're like, oh yeah, that's exactly a reasonable way to measure that. So I don't know.
Yeah. And then looking at the retailers, this is one where you're seeing a little bit of a drop off on some areas for
I
retail.
think first one's awfully interesting.
Yeah, equity versus bond fund flows, where you're seeing that was actually higher going in at the end of the year.
And it's been this big improvement in.
I guess it's just got to be the interest rates are so much better than
I
it's
guess,
attracting
but
money,
still,
right?
it's amazing, right? Look at some of these tech stocks. I mean,
Yeah, and there was the item too that we had talked about where retail had actually beaten institutional into this market.
right.
It was very reminiscent of 2020,
Yeah.
where like
and
all the
1999. Yeah.
yeah, Well, it's just funny because it feels like retail is such a group think now, and there was
Maybe
a great. I'm sure you read the most recent Epsilon theory where they were talking with Dick Clark
I
and the
did not.
crowd thinking. You would like it. It's just
All
kind
right.
of it's a breakdown of crowd thinking and all that, and I feel like that's really with the internet just exploded, where you're seeing retail kind of beating institutional in it in various
I think
different
they've
times.
also just become much more sophisticated. I mean,
Yeah.
there's just a real kind of parity there now in terms of
and and
knowledge.
and strengthened in terms of the
The world
options
is
trading
flat
and the leverage.
in the stock market.
Well, but I think that the use of options has strengthened
Sure,
their weighting,
right?
you
You
know,
got
because all
different
of a sudden they're all leveraged.
sophisticated implementation. You've got it's really hard to suppress the intel. You know, it's just kind of flattened out the world a lot.
Yeah, yeah, especially the suppressing the intel, where now everybody could get their hands on different
Everybody
notes
gets
and
their hands
everything.
on the top research, and you've got educational materials that teach you how to use the top kind of implementation styles, and
Yeah,
it's
much more
really not the
sophisticated.
same world as 20, 30 years ago in terms of that split.
You know,
But
uh,
so it's interesting to see this. I
yeah,
mean,
and then obviously and that's pretty evident in this pop up in active equity funds, right? The stock picker market that this has
although
turned
this is
into.
from Goldman.
Yeah, you think that they're just putting a little
Like,
flying
oh,
wheel.
those retail guys. Rah.
Very well could be. Very well could be. Passive equity fund flows, a little bit of a pop there. Change in net margin debt. This would be part of that options trade. And I think where obviously risk is a lot more on than it was towards the end of the year. And then that sentiment indicator that we're talking about as a whole, going from that bubble of negative sentiment to a little bit more upbeat tone. So I just thought that this was some good information here, just trying to kind of figure out where money's flowing to, how things
Sure.
have changed in the dynamics.
Yeah, sure.
All right. So risk appetite here. This is net percentage taken higher than normal risks. You can see from the fund manager's survey, it's been on the rise, but still very deep in negative territory as it's been most of the time. So again, the risk aversion bubble here, right?
Absolutely.
Here's another view of it. This is from JP Morgan. Percentage of planning to increase equity exposure. It's only at 39% here. You could see this was higher a couple of weeks ago.
Doesn't look
Then
like a bull market top.
it doesn't look like a bull market top whatsoever, does it? And in terms of looking at some of the data that we've seen, we could tell that while there's been short covering, there's still the potential for some real money getting put in, and I think that this risk appetite shows that. So that's definitely a key area for us to keep an eye out on. Then we get into the AAII versus the fund manager survey, which is just kind of the juxtaposition. And you can see the total stock allocation here. The dark blue line is the AAII, and then here's the light blue line is the fund manager survey. And this really just gets to our point that we were just
Yep.
making, Brett, right? Where retail's kind of beaten institutional to the punch this time around.
Yep.
And but that still means that there's a decent amount of institutional on the side. So taking into consideration those risks those risk appetites in this chart here, Brett, what's your read on that?
Well, so kind of why I was saying, so you get that secondary puke in a correction like this, and you get away from the sort of technical protection. And there just happens to be just, in the wastes of space, a big deep pocketed bid. Like that's exactly what I'm talking about. Is if these two lines are going to converge, that's how. Right? It's just that there's this trailing bid of really deep pocketed pro money that's just waiting for a better opportunity to get involved. And if you shake out the key technical level, you puke some people out or a little over leveraged, and there's just a deep pocketed bid, there's just an ocean of money waiting there for a chance to be involved. Then that's what really defines a continuing bull market trend, is that ocean of money is sitting there, hoping for a chance. And this chart would, kind of confirm that a little bit. I mean, it would help establish that point.
So obviously, every time we get a little bit of a bounce like we did earlier in the week, you're going to see people chasing it, thinking, okay, this could be the bottom. What are some of the chart patterns that you'd be looking for in that scenario, Brett?
Well, the important money's not going to chase.
Well, they've been very, very patient, right? Because
Well, they're not going to
that
chase at this point.
but one of the elements from August that has been sticking out to me is, number one, the volume's definitely been lighter. We talked about that earlier with the 50% drop off there, but I just get the sense that people feel that they could get stuff cheaper, right? And so I guess what's the pattern where you think that where you'd be watching and be like, okay, I think that this is kind of tipping me off to people don't think that this is going to get much cheaper here.
Well, I guess dumping a really important and obvious level, and then
Like hitting the 50, like hitting the 50-day today.
Well, no, I think really, hitting the previous low and throwing through it, and that there just can't be any continuation. You get a spike down, and there's just a bunch of money there looking to buy stocks. Like I think when you puke out the technical level, I think it's the overshoots. The bids off the overshoots to me are what indicates that in my mind. If it's a bear market, it just doesn't happen. You get a technical break, it just runs and runs and runs and runs and runs. Like, because everybody's on the other side. That money is sitting there hoping for a chance to sell. But when it breaks the technical level, people start to throw in the towel on their chance to wait to sell into a rally, and they start chasing it and selling. So if you just imagine two different universes, let's say the important money is hoping to unload. The way that we work around technical levels is completely different. But if the important money is sitting in a lot of cash, too much cash, needs to get some more exposure, when you break a level, you run into that bid. And that bid is there. It's going to be deep. If people are trying to short into it, you're going to get a couple spikes down. It's going to come right back up. The volume's going to build. The market's not going to go anywhere. And there's no technical level to explain it. There's no headlines to explain it. It's just there because you're entering, the surface of an ocean. It's an ocean deep of money that wants to chase that market back up. And that's very different from the ocean being in a cloud on top of the market, hoping to rain. It's just a different feel. And if you break a technical level in a bear market, again, it just goes. It just waterfalls. And we'll see it at those moments. And the best moment to see it in this type of market context would be if we get back down to that level at 44.25 or 43.25 to 43.50 area, and we dump it out. And there's no real obvious technical level right below that. And if the market just can't make progress down, and there's not any headlines to help it, there's not any great bullish news or anything. It's just you get stuck there, and then you see the market turn back higher. That's the type of tape action that indicates something to you.
All right, so that's what we'll be looking for. Speaking of tape action,
now we may not get that chance.
Yeah,
that happens too. It's just a V bottom and it just goes. Like that's
V bottom.
It's unfortunate.
It's been one of the more popular themes over the last 4 to 5 years, right? Yeah. Just keeping an eye out on this market too, back up to that 44.09 area. So keeping an eye out on that. Nothing too interesting's been going, but this is probably the best move that we've seen since we started the show. Okay, moving on, Brett. Mutual fund and hedge fund equity exposure. This was from a Goldman Sachs Prime brokerage note based off of ICI data. And, they've increased their equity exposure year to date. This would have been data as of August 17th. Now, the key item is year to date because it was pretty low starting off the year. But we have seen some money coming back in. That's been pretty evident in the price action too. So you got any thoughts on this chart?
So, I guess not really. I mean, okay. I don't think it really upsets what we've been covering. So
nothing there. Growth expectations, and we're going to get into that Atlanta Fed here in a second, but that's obviously, net expecting a stronger economy. That's been on the rise here. Certainly the data has been supportive of that. So, no surprise there, I would say, especially, again, given that bubble of pessimism that we talked about. Here's the Atlanta GDP, Brett. And we were talking about this now. there's definitely some holes in how Atlanta GDP is calculated and everything. But you had an interesting point in this where right now we saw the GDP forecast for Q3 is up to 5.9%, which is well above where the consensus numbers are and certainly above expectations. I mean, just look at that possible breakout there. Now, it's certainly got to get factored into what the Fed's looking at. But what's your thought process on that Atlanta Fed GDP?
Well, it's just so every quarter is a regular process of data points coming out, and this is based on tracking, using some historical information, but tracking like here's this data point, here's that data point. We get the first month of the quarter's housing starts number that has such and such an impact on this, and the formula is kind of trained over years and years and years of data to try to estimate and extrapolate from that, but it doesn't include any of the further data points for that quarter that didn't come out over the second and third month. And that's fine, but when it starts this far ahead, it shouldn't be ignored. It shouldn't be thrown out. Like it's going to take some really, really negative misses to get this back down anywhere near where consensus is for the quarter.
Yeah, more than forgetting to carry over the one, right?
Right. Exactly. This is going to take some big misses in what we have ahead. Maybe it's lined up that way. Maybe it's lined up that the types of data points that are going to really struggle this quarter we haven't had, and the types of data points that have some kind of inherent advantage we've already had. And so everything is really offset just serendipitously for people who are looking for, 1.1% GDP growth this quarter. But, it's just like you shouldn't throw this out. Like this is most likely going to end up being a quarter, and the market's already probably starting to say that with interest rate movement for sure, that this quarter is most likely going to be one that really kind of displays that people were overly pessimistic on the U.S. economy midway through the year. That what we're seeing right now is a display of much, much more robust economic strength than people had been expecting in the second half of the year. And that's probably going to be a point that carries through.
And it's certainly a factor into some of the Fed decisions moving forward. So we'll be
But yet,
that.
Fed funds futures aren't moving. This is one of the most bullish things that you can have. If you want to come up with a bullish read on things, look at this data point and look at the Fed funds futures and put them together.
Yeah.
Like this is disinflationary strong growth.
Yeah. No, well, we'll see about the disinflation. There's certainly aspects of
well,
that.
At least according to what we see now from the Fed funds.
Yeah.
Obviously, that all could change. But right now, you've got smart money involved at highly impactful levels in all of this. And this is what we're seeing is GDP now at this point coming to the end of the second month of the quarter at 5.9%. And the Fed funds futures not even thinking about moving toward another hike this cycle, which is, I would say relatively, in a traditional sense, relatively bullish.
Sure. All right, looking at the credit watch here, we got U.S. commercial real estate still at the top of concerns. China real estate, interesting enough, saw a little bit of a downtick. I'd be curious to see the exact timing of this compared to the Evergrande Chapter 15 there. But you can see that there still remains concern about U.S. commercial real estate there, EU as well, and then the U.S. shadow banking. So one of the things I just want to point out to people is a firm's going to be out after the hours. That's the buy now, pay later, which was supposedly a brand new phenomenon. Just was layaway to me without the laying away, right, Brett?
Yeah, but with no recourse.
Yeah, exactly.
I'd never gotten it. I've been like, what is happening with this thing?
When they were trying to bring it out as a new concept, I was dying laughing. I was like, it's layaway, but you're giving the stuff away before you.
It's just what? You just
Yeah.
get free
You,
stuff for one payment.
you get it, and then you just squelch on your credit. But
Like
Affirm
how
after hours,
yeah.
that's going to be one that we're going to want to watch on that credit front. So we had Macy's earlier this week. They started talking about, it was really one of the first big department store names that I saw really kind of raising a red flag. So keep an eye out on Affirm, because that's something that could definitely rattle the markets a little bit. All right. And here's a chart of the consumer charge-offs. Now, this is from last one. This is data as of July 14th, but this has ticked up even a little bit more here. You can see still at very low levels.
I was
And I
gonna
mean,
say
yeah. And so, I mean, it's
it's
context.
amazing times for this.
Yeah. You're going to see a lot of headlines like net charge-offs have doubled over the last
Yeah.
12 months. You're going to see a lot of those headlines, but this is
dude,
this is why I wanted to put this chart in. Keep
good
that
slide.
in context. So,
I mean, it's the golden age of this.
yeah, exactly. All right, then
I want to lend money right now.
Right. Here's a good chart, Brett. This kind of shows the ebb and flow of the implied Fed funds rate. Obviously, we're in 5.25 to 5.50. So a lot of people aren't looking for for another rate hike here. It's not the baseline scenario. A lot of people would argue that there's going to be one, maybe two more. But right now, the market's not pushing it in. You can kind of get an idea of where they think you're going to start cutting rates. That'd be in that May 2024 area. Now, Brett, on average, after the last Fed rate hike, it usually is 7 months before the first Fed rate cut. So that would fall into this theme. But do you have a problem with this chart? I mean, obviously it's kind of reflecting the idea that some of that tightening is going to take place. Perhaps some of that China deflation that we're talking about is taken in. But do you take great umbrage to this? And do you see anything that maybe Powell could say tomorrow that would greatly disrupt this? Certainly, the Fed's been trying to get in the higher for longer scenario, and I'm not quite sure that the market's buying that.
So, first of all, I don't think average matters in this data point. There's an average in anything, right?
Yeah.
I mean, you can take any data point and add it together and divide by the number of inputs and come up with an average, but it doesn't mean the average means anything for any new instance. And I would see this as being particularly idiosyncratic. So I don't necessarily think the 7-month idea. However, it just so happens that may be not too far off. When you're talking about orders of magnitude, and probably when you talk about orders of magnitude, the average matters a bit. So we're the market is looking for something ballpark, orders of magnitude sense in terms of when we start to see the rate trend reverse. I don't take any issue with this chart. I think it's probably pretty reasonable forward look, but that doesn't necessarily mean that, I mean, look, this is not, it's not going from 5.44 to 1.5% in this amount of time, which is what you'd see if, in the middle of 2024, we were heading into a deep global recession. We would not see 4.29% rates in November of next year. Right? The scale of this chart is a little, skewing there. Like, this is not an implosion in anything. This is probably that, if you have a soft landing scenario and it turns out that maybe the inflation that we saw was a little more transitory than we thought, then this is what you'd see, that we overshot in our hikes. Could turn out to be that we overshot enough to cause some serious economic damage. And I would imagine that this is, finding a midpoint between those two ideas. Let's say it's just because of transitory, it's at 4.8% a year from now. Let's say in a recession, it's at more 2.5 to 3% a year from now. And it's finding some kind of happy medium between those ideas.
All right. And just keeping an eye out too on the traders. OptionX, he posted an update to his trades. Keep an eye out on PayPal and HD. Could close them in the last 30 minutes here. And Momentum Trader as well, updating some of his thoughts. He's got that nice short and Best Buy going on. All right. So rates and inflation, what we were kind of just talking about there, higher percentage expecting rates to decline. No surprise That was obviously reflected in the last one. Now, just kind of taking a look at some of the data points that the Fed's looking at going into Powell, Brett. We got services, X food, energy, and shelter. You can see they've started to make some nice progress on that. It remains elevated, but certainly trending in the right direction, getting back down towards those 2021 levels. And this is
this
that
was the
sticky
big
price.
this was the big baddie.
This is the big baddie, exactly. So, that's definitely something.
There isn't anything else.
Yep. So, I mean, we'll see if that's enough to impress the Fed here. This I thought was interesting. The Fed balance sheet, Brett. We know QT's going on here, but boy, is it taking a while to get that balance sheet?
You have a second derivative. This is a big move. So I was going to say this earlier when we were talking. Second derivative. This is a big move. If you just look at like change year over year, if you replot this that way, you've just got cumulative level. And if you replot this that way, like this is below where it was, 2.5 years ago.
Yeah, but considering, so I guess my issue.
But it should be. I get you. I know where you're going. Totally get you. But still, on a second, if we had this whole thing plotted on a second derivative level, it would look like much more of a dramatic shock to the system. If the system, because the system extrapolates.
I don't get what you're saying there, because we're looking at 2020 right here. That's where you get that big spike up from the 4 billion.
What if you were on morphine and I was giving you a little bit more every day? Every day, your body becomes conditioned to extrapolate that little bit more. So even just keeping it the same the next day is a painful shot.
So you're saying this decline's still taking the sugar high out?
I'm saying that these are probably second derivative functions more than anything, because people's expectations are what set things, and when you start to condition for years and years and years that this is going to keep increasing, then just holding it the same is a big downside blow. So, and this is lower.
My issue with it is that it seems like the Fed's still kind of artificially monetizing the debt by just keeping that elevated. I don't see this as artificially lower.
Of course they are.
But so I guess the point is that QT is probably not as aggressive as they want. That's perhaps why they're looking at the rates, right?
Maybe. I just think the second derivative is the most important idea with this particular data point. To me, this is something where there's conditioning over time, and people are going to extrapolate, and just seeing it like this is flat or lower over years is a significant shift. It's not adding. It needs to be adding to do anything.
It's not adding.
It needs to be adding to do anything.
Well, they are adding, and here's the area where they're adding, right? We took a look at the Fed bank lending sheet, and I think this is another area why you're seeing this. I mean, you can look at this as temporary here. The regional banks just kind of continuing to use that Fed facility there in order to kind of keep their funding going overnight.
Well, we're in a banking crisis,
high rates.
So.
But I guess the point being is that we're not quite out of the banking crisis when you look at this, right? I was surprised to see this trending upwards. I would have expected to see this trending downwards. And the red line, this is that special facility that they put in. Yeah, I'm sure
people are starting to acclimate to, hey, there's this new thing we can scam.
Yeah, very true.
Which is true. It's not a controversial statement. That's the fact.
It is.
That's why you need bank regulation, because you got a bunch of people who are conditioned to figure out the answer to that question, all piled together into an industry that shouldn't be a controversial statement. That's exactly what happens.
The best returns with the least amount of risks, and that's obviously where they
find a way to game the system to your own financial benefit is the game, and that's why bank regulation. That's why it's so ridiculous to listen to, the San Francisco Fed sit there and say, we handle things just right a few months ago. Like we didn't need to do interest rates in the stress tests. We didn't need to.
Right. It was the bank's fault for not.
They need to be responsible actors. Yeah. Like that's not how this works. They're not going to be responsible actors. They're going to test and game every single vulnerability in the system, and you have to be, like a hawk, stopping that from happening. It's a remarkable failure at that point of regulation to me.
Yeah. Well, we'll see if any of that gets changed in the coming months, right? Moving on to the fiscal policy side of things, people think that it's just simply too stimulative, Brett. Do you have any thoughts on this?
I mean, I guess they're looking at the same thing you were looking at.
Yeah.
Right. They're expecting it to have come down further given where rates have gone.
I'd be curious, do you think that a chart like this, and I don't think it does because it's just asking fund managers, it's not asking the general public. Does this factor into the presidential race
I
for
don't know how.
campaign promises? Yeah, no, I agree with you. I don't think it does either. I just found it that was interesting that people were a little too concerned about the fiscal policy. And the last time you saw it kind of at these levels, 2018, when we got those tax cuts that we probably didn't need. And then again, 2022, that was the highs when we got that second COVID package coming in. So, but fiscal policy is definitely viewed, at least by fund managers, as being a little too generous here. Keeping an eye out.
Look, inflation's coming down powerfully.
Yeah. Yeah.
Even on the services core side. So I think that they're doing what they need to do and it's working.
Yeah. No, that's definitely a fair assessment. But just going off of what the answers we're getting in those reviews, I found that pretty interesting that they would like to see a cutback of that. S&P valuations, you can see basically trending the same direction in 2024 as 2023. So they've been moving lockstep. Again, if you're looking out at this, we're trading at about 18 times 2024 earnings. So it's not too egregious on that front. I know, Brett, we were talking about valuations. It's more of an elastic band than an exact roadmap. But, I guess my point being on this is valuations don't appear to be out of sync. So I don't really see that as a selling factor at these current levels. Then global returns, just a kind of a quick peek at that. You can see NASDAQ's certainly been the class. 2-year yields and the 10-year yields obviously seen a big pop there, but Nikkei also having a pretty good session there. Real quick, options trader, he's taking profits in his HD options trade there, so be aware of that. China, of course, the HSI down 9.3%. The Hang Seng, that is. What else do we have going on here?
The main thing is the Nikkei is, the NASDAQ and the Nikkei way out in front.
Yeah, way out in front. And the yen also seen a lot of weakness too, of course, with the carry trade. So again, that kind of factors into the yield curve controls that we're watching. But the USD, obviously a strong performer here. We are seeing it run into a little bit of resistance. And then crude, despite a lot of noise, is kind of just sitting around really flat for the year. And then gold, somebody wanted to ask specifically about gold, Brett. So real quick, what's your thoughts on gold right here?
There are times when I have really strong thoughts on gold, and there are times when I don't really have strong thoughts on gold. And that's just sometimes everything that I do has to do with the gold market, for periods. Right now, I don't have strong thoughts on gold. Each day I look at it, it's not telling me anything.
The one thing that number one, I would say that I don't use it as a gauge in inflation anymore.
I don't
It really
either.
feels like that was broken.
It's
kind of like Bitcoin. There's really no rhyme or reason to it. It's all sentiment.
It's just loose. Yeah, it's just detached. And at times people think that it has meaning. And so for anybody listening to this who's really into gold, look, I've traded gold for 25 years. And Gavin can attest to this. I know what I'm doing where gold's concerned. I've had a tremendous track record. I might have made more in gold than any other asset because there's been certain periods where I've been really, really, really all over very important and significant moves. But my theory guiding every one of those campaigns has been that nobody understands how to value it. There's no way to dig in your heels and know what the value of that substance is.
There's no way to do an inventory check.
There's no way to do it economically. There's no way to do it fundamentally. There's no way to do it.
Wasn't it the Bundesbank? Like people rumored that they didn't even have any of the gold that they said they had.
And who would know the difference one way or the other? There's no way to value it. It's astronomically above its economic value, and it's going to stay there forever. There's a scarcity argument you could kind of make, but then what does it matter whether you pull it out of the ground or not? There's all sorts of ways to look at it, but the reality is it gets moving and patterns dominate, and nobody has the conviction to dig their heels in against that move. because they don't know how to value it. So there's no, it at times starts to move, and nobody knows how to stand against it because there's no way to make a rock solid argument that it's worth less or more than its current price. So it becomes completely technical and sentiment data, 100%. And it's great for me that way because I can get on to, if I can get in rhythm with it, I know exactly what's going to happen.
I would say the chart certainly looks a little more on the negative side in terms of sentiment, but then when you pull out
time frame,
well, that's I was just going to say, but then when you pull out to a monthly, it's just kind of consolidating, right? Not just looking at the GLD.
Well, I mean, it's in a long-term uptrend where we've got a triple top. If it starts to pivot up now, I'll tell you one thing: there's no such thing as a quadruple top. It's one of the things I've learned over the years and years and years. And if you go back to 2020, we've got a triple top in place. If this thing gets anywhere near back up to those highs again, set your watch to it. It's going to go through those highs. It's not going to stop.
Well, we'll have to keep an eye out, make sure Goldfinger doesn't set off a nuclear bomb and
might do it
knock it all or anything, right?
Yeah,
but there you go on gold. No real strong call either way on that. It just kind of seems choppy. Moving along here, just some numbers on the ETF shorts, which shorts saw the largest, or listed short flows saw the largest weekly increase since September 2022. This is for the week of August 11th to August 17th. So, that just kind of factors into some of that pullback that we were seeing. And the fact that it was in ETFs certainly suggests, with the lower volume and everything that we're seeing, that perhaps this was a little bit more on the retail side for the shorting. Tech allocation, just kind of going through some of the last slides here, that remains overweight. It's the highest overweight since December 2021. We saw perhaps some of that getting shaken out today following that NVIDIA news. Then I just wanted to throw this up to S&P stocks above the 20-day moving average. This is in a percentage term. So only 20% right now. This is as of yesterday, we're above the 20-day moving average. So for me, that remains a little bit more short-term bearish. I don't know if you'd agree with that or not, Brett. And obviously that could change on a dime. But then when we're looking at the 50-day moving average, it's a little bit higher, up at 35%. But you could also argue, while bearish, also seeing a little bit of a bottoming.
But this is also what the job of a correction.
Correct.
We rebalance this stuff. I mean, we're way hot. Like if you want to pair this chart with the S&P's chart overall, this is an uptrend where we got to where things were stretched, and then we got to where things were not, and yet we made a huge amount of net gain in the interim in terms of prices.
Right, but my point being is, number one, that leadership, it remains pretty shallow up at the top, but there is room, and you can see the
value then
pattern.
is,
But that's again that's what the point that I'm getting to. You're starting to see a little bit of a bottom with these patterns there. So this is something I'm going to continue to keep an eye out on. You could see that move through June and July when we started really rallying and got up to about 85% trading above their 50-day moving average. So there is that little bottoming process coming in, and you can see we saw, if you're just looking at this 50-day moving average chart, a similar process back in late May. So let's keep an eye out on this as a potential look at breadth widening here. All right, Brett, final slide here, and final thing that we will discuss before we wrap this up. Jay Powell tomorrow, Brett. So some of the things that people are going to be looking for. Number one, he's speaking at 10 a.m. It is going to be broadcast. It's the only thing that's going to be broadcast at Jackson Hole. So they did the same thing last. So, they know where their importance is. I would note that Lagarde's going to be speaking shortly after him. But the market right now is pricing in a 10% chance of a 25 basis rate hike in September and a 35% chance by the end of the year, leaving the terminal rate at about 5.25%. And then or 5.25 to 5.50%. So here's the things that I'm looking at, Brett, that I think could be the game changers. To be clear, I don't think that Powell's going to really step out too much from where he is right now. So I'm not expecting this to be a major event by any stretch, but there are two things that could change that. If he starts talking about the R star, which has been under debate, there was a New York Fed paper earlier in the month talking about the R star, which for those of you who don't know what the R star is, this is the neutral rate on where the Fed thinks things should be. Now, R star has been running
rate, yeah.
Right. R star has been running very low over the last 10 years, naturally, but that has been on the rise. And there was a New York Fed paper that discussed this. So we want to see if Powell is going to raise this up. And that just kind of falls into the higher for longer rate. That doesn't mean that they're going to be raising, but definitely takes off the idea that the Fed's going right back to 1% rates once things have cooled off. Then the other thing that, again, I don't see him touching this, but there's been talk that the Fed could move off their 2% inflation target.
Yeah.
I don't think that's something that you want to do before you achieve the target. That's something that once you achieve the target, you could be like, after going through 3% inflation, we didn't think it was that bad. So we think we could kind of expand our target a little bit, right? Kind of what the Bank of Japan's doing with their yield curve control, I suppose, to a certain degree. But Brett, for the R star and the 2% inflation target, do you have any thoughts on that? And what's your thought process in general going into Powell tomorrow?
I think there might be lip service to the R star. I don't think there's any chance he's going to talk about the inflation target, other than to say we need to stick with what we've got. And the R star debate, I don't think there's going to be substantive discussion. I think it's going to be, I mean, I don't know. I don't have a crystal ball, but I doubt that there's going to be substantive discussion about identifying a change in the neutral rate. And I think it's going to be a really non-event situation at this point.
Yeah, I'd agree with that. If any of these were mentioned, what's your thought on that? Do you think that the market would react positively, or do you think that they wouldn't really know what to do with it?
Oh man, if they change the inflation target, the market would go booming. I mean, yeah, of course
I would agree with that.
I mean, are you kidding me? That would be just another huge version of just, liquidity expansion through communications. So
yeah, which is something I don't think that the Fed particularly wants.
No way. No way. Especially not now. I mean, no way. If they sat at 3.1% for the next year and a half, maybe. But I think you're right, though. They would rather, if they're going to do it, they would do it after they hit their target. But if they just got the sense that they're never going to hit their target and they want to normalize at a new level, it would be a lot longer than now.
Yeah, I just don't see this being the time where they'd want to even
maybe
breach that subject.
2 Jackson Holes from now if we're still at 3%.
Yeah. So they're the things that we'd be looking at for Powell. Again, I don't think either one of us think it's going to be a big event. So,
hey, sweetie, I'm on a.
No, 3 of us could go to Spanish class.
Wow, that's amazing. Thank you.
Nice Espanol.
Yeah, Espanol. I got three 6-year-olds that just burst in the door.
Nice. Well, their timing is actually good because we are about to wrap this up, Brett. So, for my take from this is that, things certainly seem a little bit uncertain for the next couple of weeks. We're kind of just in that correction phase here, pullback correction, however you want to look at it. I don't think it is anything overly nefarious. And I do, in terms of looking at the money on the sidelines, expect to see support levels eventually hold up and for us to be able to find some buyers on dips. But it's going to be a little bit choppy to get there, Brett, given a lot of the uncertainty that's out there. So that's kind of my big takeaway from this. But you always do a much better job at encompassing the discussion here. So when Brett walks away from this, is he thinking of in terms of his trading and his outlook for the markets?
Well, I don't know if I always do a much better job, but
yeah, you're right. No, I'm just kidding.
No, you do a
everybody
great job.
knows.
I got my
Knows
version
you
of
got
things.
some good stuff.
I will say that we've been I put an end capper that's very much like where we started. That we had big grand process of pricing in what I would say is much better than expected versions of certain ideas. The ideas that we had late last year and at the beginning of this year about inflation, about the Fed, about earnings, about the economy. There was a set of ideas, and those ideas led to a positioning situation. And we've endlessly highlighted the nature of that positioning situation. And that positioning situation was characterized by things like all-time high volume in put buying from small and professional investors, all-time highs in index futures short interest, 80 out of 83 weeks with decisively out of whack to the bear side AAII data. Small trader options ratios and robo ratio and the Lobo ratio and all these things all lined up by, say, January, February, March in the direction of what I termed as a mania in risk aversion. And I think that that's easy to justify. And that was based on these ideas about these concepts, that we would see, worse inflationary situation, and that we just couldn't get that sort of super core services back down. And the Fed would just keep hiking and hiking and hiking. And the economy would eventually crumble into an inflationary recession, the worst thing you could imagine, and earnings would just go to hell. And everybody be stuck with this just crap burger for the entire year at least. And even though sort of waiting in the wings, I think even under those circumstances, and I think this is an important concept, even under those circumstances, people recognized that after they'd eaten that crap burger, that there might be some really powerful growth ahead based on emerging concepts, based on the kind of course that we're on with things like quantum computing and AI and fusion energy and things like that. When you look out the next decade, there's some really remarkable potential growth scenarios that are also looming there, but that there's a year here that just was going to be awful, and everybody's just going to have to deal with it. And you've got the likes of Mike Wilson and Marko Kolanovic just saying the market's just going to completely fall apart mid-year and into the latter half of the year for all these reasons. And then we get this banking crisis too, and it just really highlights this. But all along the way, the market's not able to really price down very much. And I think those two themes are related, that you've got this longer term picture of a lot of growth, and you've got the shorter term crap burger. And there's a lot of longer term money that's willing to ride out the crap burger. And then the crap burger turns out not to be a crap burger, but a hamburger. And it's got all the fixings and it's okay. And suddenly inflation's back down to 3%. You've got the Fed calling it quits on the hiking cycle. Your earnings aren't so bad at all. Suddenly the retail money's powering back into the market and all the shorts are covering in hedge fund land. Like, that's what we saw through the end of July, was that transition from that crap burger outlook to like more normal kind of reality and a bull market trend. And we kind of checked all those boxes at that point. And where do you look next for that next same kind of catalyst? It's really hard to find. It's really hard to say what's the next data point that's going to come along that's going to further reinforce this kind of momentum. And I think, it's really hard to say to me what that is. I mean, you've got sort of like sustained inflationary healing, the Fed reinforcing it's not going to be doing a lot of hiking, earnings again not being that bad. None of those things are really a catalyst. So it's going to take the next wave, the next big kind of development in this longer term picture, I think, to re-stimulate things. And in the meantime, you've got this consolidation process that I think we're saddled with now. I don't think it's a serious reversal in the market. I think that we kind of achieved that leg, and we canceled out that extremely pessimistic sort of crap burger perspective. And now we're kind of left in this place where we're waiting for the next waiting for the next kind of, rocket to fire up, and it could be a while, I think. And I think we really need to get back to the point where people are taking some bearish bets, and we've got some short interest back in the market. We've got a balanced market, and we've got some pessimistic assumptions kind of percolating through again to kind of reset all of that, and we're working toward that. But ultimately, I think this just sets up a follow through breakout at some point.
All right, so we're just about into the close here, Brett. So it's going to do it for us over here. Definitely appreciate you joining us on audio here and taking a look through the markets and seeing what's going on. So we'll obviously be talking with you and keeping in touch and seeing if there's going to be any changes to our lookouts here. But for now, that's kind of where we see things playing out. We'll be watching this closely, of course. And if anybody's got any questions on anything, definitely feel free to let us know. Quick peek at the market. We did get a little flush down there to the 43.86 level. Looks like we are set to close right around 43.91 or so in the S&P, so below yesterday's lows, and around 12,884 in the NASDAQ. So as we await for Powell. So I'm going to shut down audio here, be back on shortly to cover the after hours movers. And Brett, you take care, and good luck with the Spanish lessons with the kids.
Yes, gracias.
De nada. All right. We'll talk to everybody in a little bit here. I'm just going to stop this stream and reboot here in 2 minutes.
All right. Take care, guys.
Take care, Brett.